Welcome. Today, we're breaking down why the world's top engineering firms are hitting a growth wall in 2026. Revenue growth is stalling, with a significant percentage of firms missing targets. It's a $2.1 trillion market reaching a crisis point. Let's get into what's happening, why it matters, and what comes next. Here's the hard data. Revenue growth across engineering majors is in negative territory for the first time in 15 years, a historic 4.2% average decline. 38% of the top 100 firms missed targets, indicating a multi-market downturn affecting all geographies simultaneously. Five forces are colliding at once. AI and automation are slashing billable hours, demanding AI-native delivery. Rising capital costs are freezing megaprojects. Geopolitical fragility is extending project timelines. The talent war and outdated time and materials business models are exposing margin vulnerability. Not all sectors are equal. Defense, government engineering, renewable energy, and digital infrastructure are the winners, bucking the trend with positive growth. Meanwhile, commercial real estate, oil and gas, and industrial manufacturing are seeing steep declines. Real firms are taking real action. WSP Global achieved growth by aggressively acquiring niche sustainability firms. Jacobs leveraged early AI adoption to offset losses. However, firms like AECOM and Technip Energies experienced short-term pain during their pivots away from underperforming divisions or collapsing sectors. The real crisis is structural. The billing model crisis, the technology adoption gap, and the talent and leadership vacuum. Legacy models are failing, tech adoption is low, and engineers are leaving for higher-paying, tech-focused roles. These structural shifts demand immediate leadership action. There is a bright side. Firms willing to pivot fast can capitalize on the green infrastructure boom, AI-enhanced engineering services, and a surge in public-private partnerships. These areas represent historic opportunities, but the window to act is short. Looking ahead to 2028, we see three scenarios. The bull case predicts rapid recovery by 2027, driven by interest rate cuts and AI. The bear case forecasts a prolonged contraction with major firm bankruptcies. Our base case, with a 50% probability, is a slow grind with continued margin compression and sector divergence. This is the action plan. Go vertical by owning a niche. Build your AI toolkit to create new billable hours. Chase government and P3 contracts as private CapEx is frozen. Switch to value-based billing. And finally, invest in your personal brand and network. Subscribe to Pawan's channel for weekly breakdowns on engineering, business, and career strategy.